When people talk about building wealth, the conversation almost always turns to stocks, index funds, and real estate. However, life insurance, especially whole life and other permanent policies, is often promoted as an alternative way to build wealth. Some financial professionals even claim that life insurance can outperform traditional investments or provide hidden advantages that stocks cannot. This raises an important question. Can life insurance really build wealth, and is it better than stocks? To answer this properly, we need to look at how life insurance works, what it's designed for, and how it compares to investing in the long run. Today, we will talk about, can life insurance really build wealth, better than stocks? So, before we start, make sure to hit the like button and subscribe to my channel. Let's begin by understanding what life insurance is actually meant to do. At its core, life insurance is designed to provide financial protection to your beneficiaries in the event of your death. Term life insurance does this in the simplest way possible, offering a death benefit for a fixed period. Permanent life insurance, such as whole life, goes a step further by combining that protection with a cash value component that grows over time. This cash value is what often leads people to believe that life insurance can be used to build wealth. A portion of your premium is set aside and invested by the insurance company, and it grows at a fixed or semi-guaranteed rate. Over time, this creates a pool of money that you can access through withdrawals or policy loans. On the surface, this looks like a savings or investment account built into your insurance policy. However, the key question is not whether life insurance can accumulate money, but whether it can do so efficiently compared to other options. This is where things start to get interesting. While life insurance does grow your money, the growth is typically modest compared to traditional investments like stocks or index funds. On average, the cash value in a whole life insurance policy grows at a rate of around 3% to 5% annually. This growth is often stable and predictable, which is appealing to many people. However, when compared to the historical performance of the stock market, typically around 7% to 10% annually over long periods, the difference becomes significant. This gap in returns is one of the main reasons many financial experts argue that life insurance is not the most effective tool for building wealth. While it offers guarantees, those guarantees come at the cost of lower growth potential. Over decades, even a small difference in return rates can lead to a substantial difference in accumulated wealth due to the power of compounding. Another important factor to consider is cost. Whole life insurance is significantly more expensive than term life insurance. A large portion of your premium goes toward administrative fees, commissions, and the cost of insurance itself, especially in the early years. This means that your money is not fully invested and working for you from the start, which slows down the growth of your cash value. In contrast, investing in stocks or index funds typically involves much lower fees. With modern investment platforms and low-cost index funds, you can invest your money directly into the market and benefit from its growth without the heavy cost structure associated with life insurance. Now let's talk about liquidity, which is another key difference. Investments like stocks are highly liquid. You can buy and sell them relatively easily, and you have direct access to your money. Life insurance, on the other hand, is less flexible. While you can borrow against the cash value, doing so involves interest and can affect the policy if not managed properly. This leads to another important concept: opportunity cost. Every dollar that you put into a life insurance policy is a dollar that is not being invested elsewhere. If that same money were invested in the stock market, it could potentially generate higher returns over time. This is where the comparison becomes critical. Life insurance may grow money, but is it the best place to grow money? However, life insurance does offer some advantages that stocks do not. One of the most significant is stability. Life insurance provides guaranteed growth and is not affected by market volatility. Your cash value does not decrease due to market downturns, which can provide peace of mind for individuals who are risk-averse. Additionally, life insurance offers tax advantages. The cash value grows tax-deferred, and policy loans can often be accessed without immediate tax consequences. The death benefit is typically paid out tax-free to beneficiaries, which makes it a useful tool for estate planning and wealth transfer. But here's the critical point. While these benefits are valuable, they do not necessarily make life insurance a better wealth-building tool than stocks. Instead, they make it a different tool with a different purpose. Life insurance is primarily designed for protection and financial planning, not aggressive wealth accumulation. Stocks, on the other hand, are designed specifically for growth. By investing in a diversified portfolio of stocks or index funds, you are participating in the growth of companies and the broader economy. Over time, this has proven to be one of the most effective ways to build wealth. Another factor to consider is scalability. As your income grows, you can easily increase your investments in stocks, allowing your wealth to grow faster. Life insurance policies are more rigid, and increasing your investment often means purchasing additional policies or increasing premiums, which may not be as efficient. Behavior also plays a role in this comparison. Some people find it difficult to stay disciplined with investing. Market volatility can lead to emotional decisions, such as selling during downturns. Life insurance, with its structured payments, can help enforce discipline by requiring consistent contributions. However, this benefit must be weighed against the lower returns and reduced flexibility. So, can life insurance really build wealth? The answer is yes, but with limitations. It can build wealth in a slow, steady, and predictable way. However, it is not designed to maximize wealth or compete with higher return investments like stocks. Is it better than stocks? In most cases, no. Stocks have historically provided higher returns and greater long-term wealth-building potential. While they come with more risk and volatility, they offer the opportunity for significantly greater growth over time. The real takeaway is that life insurance and stocks serve different purposes. Life insurance is primarily a risk management and financial planning tool, while stocks are a growth-oriented investment. Trying to use life insurance as a replacement for investing often leads to suboptimal results. However, this does not mean life insurance is useless. It can play an important role in a comprehensive financial plan, especially for individuals who need guaranteed protection, tax advantages, or estate planning strategies. The key is to use it correctly and not rely on it as your primary wealth-building vehicle. In conclusion, life insurance can build wealth, but it is not designed to do so as effectively as stocks. While it offers stability, guarantees, and tax benefits, it generally falls short in terms of long-term growth potential. Stocks, with their higher returns and compounding power, remain one of the most powerful tools for building wealth over time. The smartest approach is to understand the strengths and limitations of each and use them in a way that aligns with your financial goals. Another important factor to consider is economic conditions. In periods of high inflation or strong economic growth, stocks tend to perform well because companies can increase revenues and profits. Life insurance, with its fixed or conservative growth structure, may not keep pace in such environments. Conversely, during periods of market instability, life insurance can provide a sense of financial stability that stocks cannot. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.